What's up, apes? Welcome back to the Daily Peels podcast / video stream of the day. My name is David. It is currently 6:19 p.m. here on this beautiful Thursday, July 11th, 2024. Coming at you a little bit earlier than usual, which kind of sucks because normally if we did this at our usual time, we'd be able to say, it's 7-Eleven on 7-Eleven, but I think we have more than enough coolness going on in the market action of the day and the economic data that came out that we don't really need that to keep our heads above water. Now, some of the cool shit that happened today, first and foremost, this was the second time since 1979 in which the Russell 2000 appreciated by at least 3% on the same day as an S&P 500 decline, and that's exactly what happened today. We'll get into why in just a quick minute, but another cool stat for you. This was only the first time in history that the NASDAQ composite underperformed the Russell 2000 by more than 5 percentage points. The first time in history that that's happened. Like I said, we'll talk about exactly why in just a quick second. Big day for small cap stocks, but exactly the opposite for large cap mega tech stocks. We got deflation. We're heading into earnings season. Things are about to get crazy. So in order to get ready for it, let's go ahead and break down some of the biggest news of the day. So first and foremost, we'll cover some banana bits. Despite today's historic drop, the absolute disgustingness that was the market for the session here today, 2024 is on track to be one of the best years in market history. So we are setting records for the most all-time highs achieved, or the most all-time high closes achieved in a calendar year. The only other years that come close are, I believe, 2021 and 1995, I think was the other year that it said in the article. So record-setting year for us so far. Meanwhile, calls for President Biden to step out of the presidential race, they are skyrocketing, just like the Russell 2000 did here today. Meanwhile, Pepsi reported their second quarter earnings then, and Delta Airlines got us started. We'll talk about Delta in just a second because it was a very bad takeoff for the current quarter. And finally, $15 per hour, more like $0 per hour, because automation is here in the fast food industry. I just realized I didn't even talk about what markets actually did here today. So first and foremost, the NASDAQ and the S&P 500 both lost roughly almost a percent, at least for the S&P 500. The S&P was down 88 basis points, while the NASDAQ was down almost 2%, losing 1.9 to 5%. Horrible day for big tech stocks. The main driver was, or at least appeared to be, profit-taking heading into earnings season. These stocks are at all-time highs, have been carrying the entire market. So we can't really blame investors for getting a little bit nervous, especially when we've started to see data around economic slowdowns going on. So these big tech companies, they have the biggest exposure to the overall economy. Kind of the bigger a company gets, the more likely it's just going to track alongside with GDP growth. So since we've been seeing slowdowns in things like employment, especially in GDP growth, real wage growth, markets appear to be expecting a similar slowdown in tech stocks for this current quarter. We'll see if it actually plays through, but that's my guess, is that it's kind of a profit-taking sell-off before we head into the quarter. Meanwhile, WSO Alpha absolutely destroyed the indices for the session. We were down only 46 basis points, thanks to fucking Tesla completely fucking us up. Otherwise, we would have been doing great because our housing stocks had an absolutely phenomenal day. These are all things that we're going to talk about in just a quick minute. But first, let's get into the main economic story of the day. So I'm sure all of you are familiar with the song American Pie by Don McLean. Bye Bye American Pie, absolute banger. Nonetheless, I'm currently working on one for Inflation Pie because mark your calendars today, Thursday, July 11, 2024 was the day inflation died. That's exactly what we saw here today in the data. Let me go ahead and show you exactly what I'm talking about. So what we're seeing in this chart is the monthly CPI inflation print. So this is how much prices change on a month-to-month basis for the past 12 months. Look at this. Look at this. Do you see that? Do you even recognize it? Because that's going below zero. Inflation on a monthly basis clocked in at negative 0.1% for the month of June. That's not disinflation. Doesn't mean price pressures are slowing down. That means prices are actually falling. That's what we're seeing at least throughout the month of June. We'll get into exactly what caused that in just a quick second. But it's the day inflation died. We finally broke its back. J-Pow might not be ready to declare victory just yet, but markets essentially were with the way the price action moved and the jump that we saw in the odds for a rate cut by September. So we got charts on that in just a quick second, but first of all, let's talk about exactly what caused this drop. So the biggest thing was undoubtedly energy. Now, energy prices declined by quite a bit for the month of May, and they declined even further for the month of June. So overall, gas prices were down 3.8%, according to AAA. Gas prices are currently at a level of about $3.54 per gallon. Now, that's not necessarily going to be the biggest factor in the underlying energy index within the CPI. They'll typically measure things on more of an industrial, wholesale basis rather than just prices at the pump. But nonetheless, that's the price that we're seeing in obviously, it's moving in the right direction for consumers. Now, The overall energy index shed about 2% for the month, and that was really the biggest reason for the decliner. But we also saw a major slowdown in cost of some more important things, and these especially came to fruition in the core inflation data. So what we're seeing here is the annual change in both core and the all items index for the CPI. As a reminder, the core index excludes both food and energy prices. So the decline in energy isn't changing this at all. Nevertheless, it was the lowest core inflation reading that we've seen since April 2021 at 3.3%. All of these were well below, the market's expectations or economists' expectations, by the way. Core inflation basically was triggered by 70% of the increase in core inflation was triggered by shelter costs once again. But still, if we dive deep into the shelter data, what we can see is that there was a 0.2% increase in overall shelter and a 0.3% increase in the rental index within the CPI. We know how shitty the shelter index is, but nonetheless, those were both the slowest growth rates since August 2021. The reason that we hate shelter so much is because they use a metric called owner's equivalent rent. Effectively, what they do is call fucking landline phones around America. So your senile grandparents are who they're talking to, and they're saying, hey, how much would you rent a spare room in your house for? That's effectively what they do, and based on the changes in the average levels given by the respondents, that's how they determine owner's equivalent rent, which is 33% of the CPI. So it's fucking ridiculous. That's why J-Powell doesn't really look at it too much, or at least he claims to be like Big Sean saying, I don't give a fuck about you, but nonetheless, the market clearly does give a fuck. The market absolutely gives a fuck, and we can see that in the data in terms of the changes of interest rate change probability, or the changes in the probabilities for an interest rate cut at the September FOMC meeting. That's what we're seeing in this chart right here, and specifically in this row. Go look at the chart in the piece because you're not going to see it in the video stream here today. But we saw the odds of a rate cut in September, a 25 basis point cut, jump from a very nice 69.7% on July 10th to 86.3%, a 16.6% increase in the odds for a rate cut at the Fed's September meeting. So obviously something that we're all very excited to see. The housing market absolutely loved it. Basically everybody loved it, and it just happened to coincide with the sell-off within the tech market. Now obviously there's going to be other things that we're paying attention to in the meantime, especially the initial estimates for Q2 GDP growth. We should be getting that at the end of this month. We should be getting the first preliminary estimate, and then another one at the end of August before the Fed has to make their decision. We're also going to get 2 jobs reports in the meantime and 2 PCE reports as well. So we're going to be paying very close attention to especially the jobs report and the GDP growth report to see how growth is changing and how employment is, because it seems like the Federal Reserve is much more focused on its full employment side of the mandate rather than price stability, because once again, this is the day that inflation died. Just so we know as well, by the way, this is the first time that we've seen a decline in inflation since January of 2019, at least on a monthly basis. We fell 0.1% then. I'm obviously excluding the spring of 2020 because it was basically negative from March through May of 2020, but obviously, the entire economy shut down, so we're not necessarily counting that portion. And it was the 3% reading was tied with the June reading of last year for the lowest in the past year or so. We can see that in the prior chart that we have on here. So it's tied with June of 2023. You might be thinking it's possible for it to spike back up going into the winter, especially with kind of higher heating demands. Energy prices might increase. Probably not, just because we've seen such a deflation in the strategic petroleum reserve that we should have enough already flooding the market to be able to keep prices subdued. Plus, if global warming keeps up all the good work, I mean, maybe we won't even need it going forward. So great day for inflation, terrible day for markets, but some stocks were absolutely loving it. And just to hit on a couple of those, first and foremost, this one has nothing to do with inflation, but we have QuantumScape up 30.5% for the session. A huge day for the battery maker because they struck a deal with the second largest global automaker by revenue, at least in 2023. They kind of go back and forth, Volkswagen and Toyota. So QuantumScape struck a deal with Volkswagen, and essentially they're going to be licensing their technology for solid-state batteries to be produced in Volkswagen electric vehicles going forward, especially in their next generation vehicles coming out in 2025. That's a huge revenue stream for the company, so everybody was very happy to see it. It's interesting to see that European automakers are the driver of some of the innovative technology. So we come up with it here in the United States, they put it to use over in Europe. SoundHound loves to see it, QuantumScape loves to see it, and I'm sure American venture capitalists do as well. Moving down into some of the stocks that were impacted by the inflationary data for the day. Nobody loved it more than housing stocks. And of course, we are balls deep in housing within the WSO Alpha portfolio. Names like DR Horton, Builders First Source, and Zillow are all held within the WSO Alpha portfolio, all of which were up more than 4.5%. DR Horton, this is a home builder, the second largest home builder in the United States behind only Lennar, was up 7.3%. Meanwhile, Builders First Source, they basically supply materials to those home builders. They were up 7.4%. And even Home Depot got in on the action, up 2.8%. So definitely go ahead and check out the WSO Alpha portfolio as well if you don't want to miss out on these going forward. But effectively, it was just because rates are down, mortgage rates are supposed to go down, or inflation's down, so the federal funds rate should get cut, and that should lead to cuts in the 10-year yield, which will then lead to declines in mortgage rates. So it's a 4-step process right there, but nonetheless, markets are already pricing it in, and these housing stocks absolutely love to see it because it opens up the market for buyers, and especially it'll encourage sellers to want to sell if we can bring rates down below the prevailing level of about 7% when it comes to mortgages. So if they can get a 6% rate instead of 7%, there is a marginal group of homeowners that would accept that, be willing to sell, move, expand the market just a little bit more. Okay, moving down into our shit-stain decliners of the day, we have first and foremost Tesla. Obviously, this is one of the biggest positions in the WSO Alpha portfolio, so we absolutely hated to see this announcement, but nonetheless, the company is going to be slamming the brakes on its robo-taxi service for the time being. Teslas, they go 0 to 60 in less than 4 seconds for the most part, some less than 3 seconds, and I think some even less than 2 seconds if you get all the expanded features. That's basically what the stock price has done since that April 22nd date. It's up 85% before the session here today. Today it was down 8.4%, so obviously that killed it. But once again, they had to slam the brakes. They were approaching a yellow light, and they came out with the disclosure that they are not going to be releasing their robotaxi service in August like Elon Musk had previously stated. I think everybody kind of knew that they weren't going to do that, but nonetheless, the market clearly didn't, or at least they're very upset about it, because now that it's going to be delayed until October. It's going to be interesting starting out a robotaxi service when there's snow on the ground in a large part of the country, but we'll see how they do it up there in northern Maine and in buttfuck Midwest, whatever, Montana, North Dakota, wherever people are unfortunate enough to live. I doubt anybody out there actually owns a Tesla nonetheless. There's no chargers. I don't even know if there's gas. I don't even know if there's people out there nonetheless. But either way, I guess we'll find out going forward. We'll see how that goes. Nvidia also down 5.6% for the session. So very tough day for mega cap tech stocks. Once again, the only reason that I could find that this might be attributable to is that people are starting to take profits as we roll into Q2 earnings season. I don't see what else this could be related to. I don't see how declining inflation or deflation hurts these tech stocks. Maybe it hurts pricing powers in their monopolies, but I really don't think that inflation is the reason that, NVIDIA's been able to charge such high prices and Meta gets such high ARPU on its users. So quite honestly, I don't think it has anything to do with that. Sometimes market fluctuations are just random. That's a thing that nobody wants to tell you in financial news, but that is the case nonetheless. I do think that this was driven by profit taking because we saw it across the board in big tech companies. They're going to start releasing their results next week and in the weeks after. Tomorrow is when things really get started with the bank earnings report, but we did get started here today with Delta Airlines. And that is exactly what we're talking about for our Thought Banana. We have earnings spotlight on Delta Airlines. They were down 4% for the session after releasing their numbers early yesterday morning. So really, it was a problem that we face quite often here at Wall Street Oasis, and that I face quite often in my personal life, and that's just the problem that Delta is just simply too good. So in case you guys haven't noticed, there's been a bit of a travel boom going on. This past Sunday, July 7th, was the busiest day in the history of the TSA, which is the Transportation Security Administration. Here in the United States, there's those guys that fill you up, fondle your balls a little bit when you're walking through those metal detectors and they think you might have a snow globe on you. How dare you bring a snow globe onto a plane? TSA will stop you. Thank God for protecting us from things like snow globes and shaving razors across the United States, but apparently missing every gun that goes through. Nonetheless, we're not talking about the ineffectiveness of government agencies today. We're talking about shitty Delta's earnings. And nonetheless, they actually weren't that terrible. So to go over some of the numbers here, Delta earned $2.36 per share on $16.65 billion in total sales for the second quarter. Markets were expecting $2.37 per share on $16.25 billion in revenue. So Delta was able to beat on revenue and they missed on earnings. And the basic problem is that there's too many poor people flying on their planes. Way too many me and yous are taking up seats on those planes, and they are absolutely not having it whatsoever. Now, if we go ahead and take a look at some of these charts, we can start to understand why. What we're seeing here is revenue and net income growth over time. So in this kind of in the bar chart portion of the chart here, or of this graph that we have here, that's where you're seeing revenue. So obviously revenue growth was good. It was record-setting revenue for the quarter, but at the same time, net income is still below where it was in the fourth quarter of 2023. It was an improvement on the first quarter and a roughly in line with the second quarter of 2023, a slight decline, but nonetheless, not really anything worth freaking out about. But when we look at it on a per unit basis, that's where the trouble really comes into play. So what we're seeing right here is an interesting chart that I put together. These bars, that's revenue per seat mile. And then this blue line right here is the fuel cost per gallon. These are the averages over the entirety of the quarter. And what we're seeing is an increase in the fuel cost per gallon and a decrease in the revenue per seat mile. Revenue per seat mile is basically just average revenue per passenger per mile flown. So it's kind of like their ARPU for these airlines. It's a little bit complicated because of seats and passengers, and they do total miles instead of just flights, which makes more sense because it's a more standardized metric. But nonetheless, we're seeing declines in the average revenue, increase in the average cost, so obviously that's going to be squeezing margins. And the basic problem is that a lot of this pent-up travel demand, or the travel demand that's going on right now, they're jumping all over these discounted flights. So it's very important for these airlines in the post-COVID era to pop up at the top of the search box, because when most people go, or at least when most people in my demographic go to purchase plane tickets, we do a sort by lowest to highest, and it's very important to come up at the top of that lowest order. So even though Delta has done a fairly decent job of managing this, with more than 50% of their revenue coming from very high margin segments like the loyalty club and the premium ticket sales, what they're struggling with is selling too many discounted seats on their flight. So that's basically the exact problem. They're losing money on a lot of those tickets, and people are snatching them up nonetheless. The discounted flights had a much higher magnitude than the increased revenue percentage to those high margin segments that we just discussed. So that's the basic problem going on with Delta. They're selling too many discounted tickets because demand is just way too high, and people are snapping them up as soon as they become available. So maybe other airlines will follow suit. We'll be watching for that going forward. You traveling anywhere this summer or for the rest of the year? If you are, definitely let us know where, because we would love to hear that. We'd love to take kind of a nice survey to see where the WSO Daily Peel apes are headed off to for the rest of 2024. We're going to keep it nice and short here today. Thank you all for joining us once again. We'll see you tomorrow. Happy investing, happy trading, and bye now.